Hello, I'm going to talk about Financial Accounting Chapter 6, just so you can kind of look through something and rewind it if you need it. But we're going to talk about inventories. Inventories can be difficult for some people. Honestly, they're quite easier than other things. So just get your feel for them, and so you can kind of read through those and see what we're doing. But the most important thing that I would like to walk through is FIFO, LIFO, and weighted average. FIFO stands for first in, first out. LIFO stands for last in, first out, and weighted average is simply an average. We're going to do both perpetual and periodic, although the shift between them is pretty easy. When we talk about inventory controls, basically controls are kind of what we want to do to prevent loss or theft. And so we want to safeguard inventory, and we want to make sure it's reported correctly in the financial statements. This is on your handout. I want list some things regarding that issue. This is pretty important, that before you pay for inventory, you want to make sure you match the purchase order with the receiving report with the vendor invoice. So notice that you have to match those three things. So if you think about it, if I order something online and what comes in the mail isn't what I ordered, you're not going to pay for it. However, in a business, the ordering department is separate from the department that opens the inventory or sets the inventory out, and that's separate from the accounting department who pays for it. So unlike when you order something online, how in a business do we know that what we ordered is what we got, and what we ordered and what we got is what we're paying for? And so you just simply match these three documents before you pay a bill. So make sure that you know that. That's an incredibly important item in inventory control, that before you pay for it, you match these three documents. Then a couple of other important things as far as inventory, and you can kind of read what the purchase order does. Basically, the purchase order, somebody goes out and researches the companies and makes sure that it's an authorized or approved vendor and that they're getting the best price for it, etc. And then when you get it in, you want to reject any items that aren't satisfactory, so the receiving department fills out a receiving report. Another control over inventory is having a subsidiary ledger. So every single item of inventory has its own subsidiary ledger. This is what allows you to go online and order a pair of tennis shoes and find out immediately that they have or do not have the pair of tennis shoes you want in your size and in your color. So that's a subsidiary ledger. So we will generally ignore the subsidiary ledgers. So basically we will debit inventory and credit accounts payable. I simply won't debit inventory size 10 blue shoes. We'll just debit inventory. Another important thing that as far as controls, and I don't know that they necessarily have it here. Let me see. Okay. But basically what you need to do is whenever we talk about internal control anywhere, you need to separate out authorization. Let's see if I can type that. You need to separate out authorization from record keeping from custody. So in other words, somebody will authorize the inventory or authorize that it's coming out of inventory in for a sale or coming out of inventory to be manufactured. The accounting department keeps record of it, and whoever has in charge of the warehouse or storeroom has real custody of the inventory. So you don't want the custodian of the inventory to also have record keeping responsibilities, because then they could alter it. So in other words, when I order inventory, the inventory is authorized to be ordered by the purchasing department. So that's my authorization. And then accounting is my record keeping. So the purchasing department authorizes it. A copy goes to accounting that we got 100 items. Okay, when it gets here, the storeroom has custody of it. The storeroom will count it and also know that we have 100 items. Okay, if those items are used, let's say in manufacturing, whoever is requisitioning them from the shop where they're manufacturing it, that's called a materials requisition. They're requisitioning it out. So that's the authorization coming from there. So let's say they're going to authorize that we need to use, these are 100 items at $1 each. Okay, so we're going to authorize that I need to get 20 from there. Okay, so what happens is 20 gets, the storeroom gets notice that we need 20, but a copy also goes to accounting. So accounting knows that there are 20 going out. The storeroom cannot let them out without that authorization. So notice if the storeroom clerk would take them, they're not allowed to give the authorization, so they can't, if a piece of paper came from the storeroom saying they released some items, accounting would go and ask why. But anyway, so then what accounting needs to do is go occasionally walk up there and make sure there are 80 items on hand in the storeroom, so you know the storeroom clerk didn't take it. The accounting can't take it because all they do is keep records on it. So a lot of times, you know, people say accountants handle a lot of money. Honestly, accountants don't handle money. Accountants keep the records of it. The treasury, a part of the firm, will keep the money side of it. And the same way with inventory. Accountants don't keep the inventory. Accountants might go count the inventory occasionally, but the storeroom has the inventory. Accountants keep track of it. All right, so make sure you know you separate authorization from record keeping from custody. And you need to, for a good internal control system, those are housed in 3 separate departments. All right, some other safeguarding things, especially if you had, I guess some, you know, certainly pharmacies would keep their inventory locked up, and the more abused substances, they would keep highly authorized to get it out, have signatures. If you had any types of firearms or ammunition, you're going to have it much more controlled than you would, say, a box of Kleenexes. So high-priced inventory, or honestly highly regulated or dangerous inventory, two-way mirrors, etc. Then occasionally, usually year-end at least, but sometimes more often than that, you actually go count the inventory and make sure that the inventory records are correct. Because you need to have on your financial statements an accurate count of inventory. So if inventory is disappearing due to evaporation or waste or theft or something, we need to get our inventory to its correct count. So we have 3 cost flow assumptions. And notice I have 4 methods over here, but the 3 methods are first in, first out, last in, first out, and weighted average cost. But notice I have 4 here. There is one more called the specific identification, which I'll talk about for just a second. But anyway, so those are the 4 inventory methods. First in, first out, last in, first out, and weighted average. Okay, so I'm going to skip through these. Actually, maybe I'll talk about the specific identification. We don't really cover the specific identification a whole lot because it's just what it is. So notice I purchased 1 at 9, 1 at 13, 1 at 14. And let's assume that let's just stay here for a second. Let's say I sold one. So whenever we have a sale, we have 2 entries, accounts receivable and sales for the selling price, and then cost of goods sold, and we already talked about this in a prior chapter, and credit for inventory. Okay, the accounts receivable sales is whatever I sold it for. In this problem, I don't know that, so I'm going to just put a question mark there. But the question is, which one of these did I sell? And under specific identification, you're told. So I either, let's say I sold the $14 one. So I'm just going to put cost of goods sold inventory for 14. And you'd certainly want to use specific identification for high dollar, very unique items. So for instance, if you had famous paintings, Renoir, Degas, Monet, Van Gogh, those type of things, you would certainly want to know which one you sold. But for the most part, a lot of times we're selling pencils, or we're selling bottles of water, or we're selling something mass produced, and we don't know exactly which one we sold, nor do we care which one of these we sold. We just need to have some method in accounting to pick one and go with it. And those are the three methods. Okay, there's our specific identification where we identify the exact item. But we're going to go through these other cost flow assumptions, and I'm going to kind of just go ahead to find that slide where this is. Okay, so the first one we're going to do is Fifo method. So what I would encourage you to do first is to go to the sales and circle them. I gotta get some kind of color here. Okay, so I didn't do very well with my color, but I just want to not get the sales confused with the purchases. So I'm going to highlight those sales. That was a better job. Okay, so then I put these over to the side. So I sold at $30 per unit, 700 units. So I have $2,100 here. So that's just the 30 times 700. I have 30 times 360 is 1080, so write them out to the side, do a better job than I did. And $30 times 240 is 7,200. So I don't know why it moved down there. I had it beside it first. So basically, this 700, that's the price of it. This 360, that's the price of it, and the 240, that's the price of it. Okay. So that's going to be an important part of it, but I also want to just, again, separate out the sales. All right, so now let's go to the entries here. So on the entries, whenever you have, I lost all my numbers. So make sure you write down those and do what I did. Now I'm going to just clear it. All right. Okay, so the first thing, on January 1st, notice I only have 3 columns. I have the entry, which are those over here. I don't usually have a separate column for purchases. You'll see why in a second. So I ditched this one. And then I have cost of goods sold and inventory. So here's your 3 columns on this sheet. So on the first thing I want you to do, right in here and write down the inventory balance. I'm not going to write it. I'll just show you where to write it. So you're going to write that right here. My inventory balance is 1,000 units at $20, okay? So that's what I had on hand at the beginning of January, 1,000 units at $20. Then I sold 700 units at $30 per unit. So whenever you have a sale, you have 2 entries. So this one right here goes in this column right here. So I'm going to debit accounts receivable sales for what I sold it for. That's the 2,100 you would have written over there. Okay, and then I'm going to debit cost of goods sold and inventory. But leave the amount blank because we're going to determine what that is. Okay, what I do is I go up here and say, okay, first in, first out. Under first in, first out, the first ones that came in are the first ones that went out. Well, I only have $20 ones, so it has to be $20. So in your cost of goods sold, I guess I do have a purchases column. So I have 700 at 20 is 14,000. So write that in your cost of merchandise sold. 700 times 20 equals 14,000. Write that there. And then I go back here and I use that number there. Now go to your inventory balance. I had 1,000 of them. I sold 700, so I have 300 left. Since I only have $1 unit cost, it's $20. And so 300 times 20 is 6,000. Now we're going to go to the next one, and the next one is a purchase. So we're right there. So when I have a purchase, I debit inventory, credit accounts payable, and it tells me I purchased 500 at $22.40. So 500 times $22.40 is 11,200. So now, So you're going to write that in the purchases one. Now I have 2 layers. So this comes down here. Always restate your layers every time you have it, because this is where we're going to look. This is the important one. So now I have 300 at 20, that comes down, and I have 500 more at 22.40. Quite frankly, these total cost ones aren't really important until we get to the end. But so now I have 2 layers, 300 at 20, 500 at 22.40. Next one, I sold 360 at $30 per unit. So again, I have 2 entries when I have a sale. So we'll write down here, it's accounts receivable, sales, cost of goods sold, inventory. I would get those 2 entries written and then come back and think of the amount. So if you look over here on your paper where you wrote before that I erased, you should have 10,800. So I sold them for 10,800. Now I've got to determine what they cost. So I sold 360. I would encourage you in your cost of goods sold computation, let's switch colors here, that you write down here, write 360. Because I want to total up to 360. So again, hopefully you're writing these from here on there. All right, so I'm going to look right here. Those are my inventory layers. I have 300 at 20 and I have 500 at 22.40. I sold 360. So my layers first in, first out are going to come from the $20 ones. So I have 300 here. That's a 300 at 20. And then I need my other 60 coming from the $22 ones. So 300 at 20 and 60 at 22.40. I have it totaled up to 360, and I generally will encourage you to do that so you don't lose count. Okay, so now my 300, of these 300 right here, they're all gone, so I have nothing left of the $20 ones. And of the 500, I sold 60. So 500 minus 60 is $440, 440 of the $22.40 ones. Okay, then I sold another 240 at 30. So again, whenever I have a sale, I have 2 entries. So look down here where you wrote that and see that I sold it for 7,200. So I have 2 entries: accounts receivable, sales, cost of goods sold, inventory. So I'm right down here in the 28th with this entry. Okay, right in the 7,200, we're going to determine the 53.76. So what you should have right now are, let's go right here to where we are. We're on the 28th. Okay. And so I've got my entry there. So now I'm going to go over here to my inventory balance in the line above it. I only have items that cost $22.40, and I sold 240 of them. So again, I want to draw a line in here that comes out to 240 so I don't mess up in case you have 4 or 5 layers. And I work from the top down, first in, first out. Well, there's only 1 layer, so the first one in is the same as the last one in. So I use the 22.40. I sold 240 of them, so 440 minus 240 is 200 left. So I have 200 left that cost me $22.40. So remember, items are either sold or still here. So this plus that has to be 440. All right. Then on the 30th, I purchased 600 more units. And so my purchase is 600 at $23.30. So 600 times $23.30 is $13,980. And now my inventory balance is 200. Bring this one down. 200 at $22.40, 600 at $23.30. Then if I sold, let's say 300 later, I'd sell 200 of these and 100 of those. All right, so the important things here. So once I do all of that work, okay, we're going to fill in this amount. Okay, so the first thing I want you to do is fill in your sales. So if I go up here and I add up my sales, I'm going to draw lines. I had sales of 21,000. I had sales of 10,800, and I had sales of 7,200. I believe I wrote that up here in a total also. So I believe those add up to 39,000. So you're going to write 39,000 in this box right there. Okay? So I have sales of 39,000. So remember, sales go on the income statement. Income statement is for the period ending. So I want all the sales in that period. All right, now I've got cost of merchandise sold. Two places you can get cost of merchandise sold. You can just add up these numbers right here, or they're the same numbers as over here in the entry for cost of goods sold. So I could add up 14,000. I could add up 73.44. And I could add up 53.76, which are that number, those two numbers together in that one. So my cost of goods sold is 26.70. So you're going to write that right there. Okay? Then I'm going to write gross profit. Sales minus cost of goods sold equals gross profit. So sales of 39,000. And my cost of merchandise sold is 26,720. Can't type very good. Can't get it in the right place. And so sales minus cost of merchandise sold is gross profit. So my gross profit is 12,280. Okay. My ending inventory. Inventory is on the balance sheet, and the balance sheet is on a specific date. So my balance sheet ending inventory is only those two blue numbers. That's what my inventory is on the last day of the month, is 4480 plus 13980 for a total of 18460. So write 18460 right there, and you have all those. Okay, so I'm going to pause this and record the LIFO in a separate video because sometimes my sound doesn't work and I really don't want to redo it all.